As Warren Buffett once said, "Price is what you pay, value is what you get." Welcome to our deep dive into the investing wisdom of the Oracle of Omaha. Born in modest circumstances, Warren Buffett's astute financial acumen propelled him to the zenith of wealth, making him one of the planet's wealthiest individuals. His journey, marked by shrewd investment choices and an unwavering philosophy, is a testament to his genius. So, what's the secret to Buffett's success? Let's uncover his recipe. Warren Buffett once shared, "The stock market is a device for transferring money from the impatient to the patient." This nugget of wisdom essentially encapsulates his investing philosophy, but let's delve deeper into that. Buffett, fondly known as the Oracle of Omaha, isn't just a stock picker. He's a company buyer. He doesn't see himself as owning pieces of paper that go up and down in price. Instead, he views himself as a part owner in a business. When he buys stock, he's buying a slice of that company, and he's in it for the long haul. His strategy? Buy businesses, not just stocks. This brings us to his value-oriented investment approach. Buffett looks for companies that are undervalued, those hidden gems in the market that others may have overlooked. He doesn't chase after the latest hot stocks. He seeks out businesses with solid fundamentals that are selling for less than their worth. He's a bargain hunter, but not just any bargain will do. He wants quality at a good price. But here's the thing. Finding these undervalued companies takes time, and making money off them takes even more time. This is where patience comes in. Buffett doesn't jump in and out of stocks based on market fluctuations. No, he sticks with his choices, often for decades because he believes in the businesses he's bought into. That's why he said, "Our favorite holding period is forever." And to execute this strategy successfully, one needs discipline. It's easy to get swept up in market trends, to panic when prices drop or to get greedy when they soar. But Buffett maintains a disciplined approach, sticking to his principles even when the market is in turmoil. So what can we learn from Warren Buffett? Investing is not a get-rich-quick scheme. It's a long-term game that requires patience, discipline, and a keen understanding of business fundamentals. You're not just buying stocks, you're buying businesses. And the best businesses to buy are those that are undervalued but have solid fundamentals. Buffett's approach is simple, but not easy. It requires patience, discipline, and a keen understanding of business fundamentals. Buffett famously advised, "A very low-cost index is going to beat a majority of the amateur-managed money or professionally managed money." Now let's unpack that statement a bit and delve into what's known as Buffett's 90-10 investment rule. This rule is a form of passive investing, a strategy that's all about playing the long game. Instead of actively buying and selling stocks, with passive investing, you're simply buying into the market and then, well, waiting. You're not trying to time the market or outsmart the crowd. You're just riding the wave of the market's overall growth over time. Here's where the 90-10 rule comes into play. Buffett recommends investing 90% of your portfolio in a low-cost index fund, specifically one that tracks the S&P 500. The remaining 10%? That goes into short-term government bonds. Now you might be thinking, why the S&P 500? Well, the S&P 500 is a broad market index representing the performance of some of the largest and most influential companies in the United States. It's diversified, it's stable, and over the long haul, it has a proven track record of solid returns. As for the 10% in bonds, this provides a buffer, a safety net if you will. Bonds are generally less volatile than stocks and can provide a steady stream of income, which can be particularly beneficial during market downturns. So why does Buffett advocate for this 90-10 split? It's all about balance. You've got the growth potential of the S&P 500 coupled with the security of bonds. It's a simple, straightforward strategy that doesn't require a finance degree or a crystal ball. But remember, it's not about getting rich quick. It's about patience. It's about letting the market do its thing while you sit back, relax, and watch your investment grow. Buffett's 90-10 rule is a testament to the power of simplicity and patience in investing. As Buffett wisely said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This highlights one of the key takeaways from his investment philosophy: the importance of understanding a company's business. Buffett never invests in a company he doesn't fully understand. He believes in the power of knowledge and research. It's not about chasing the hottest stock or getting swept up in market trends, but about finding solid, understandable businesses that will stand the test of time. Next, let's talk about the power of patience. Buffett is known for his buy and hold approach. He's not interested in quick profits or short-term gains. Instead, he believes in the power of compound interest and the value of long-term thinking. As he likes to say, our favorite holding period is forever. In today's fast-paced world, this kind of patience can be hard to come by. But remember, investing is not a sprint, it's a marathon. Lastly, Buffett's wisdom teaches us the value of simplicity. He suggests a 90-10 portfolio, 90% in a low-cost S&P 500 index fund, and 10% in short-term government bonds. This approach may seem too simple to some, but its beauty lies in its simplicity. It's easy to understand, easy to implement, and it has proven to be highly effective over the long term. You don't need to be a Wall Street whiz or have a finance degree to be a successful investor. You just need to keep things simple and stick to the basics. In a world that often overcomplicates things, Buffett's words are a breath of fresh air. His wisdom cuts through the noise and gets back to the fundamentals of investing, understanding what you're investing in, having patience, and keeping things simple. Remember, as Buffett said, risk comes from not knowing what you're doing. So educate yourself, be patient, and invest for the long term. Warren Buffett's wisdom is timeless, and his approach, though simple, has proven to be incredibly effective. Today, we've journeyed through the philosophy that built one of the greatest fortunes in the world. The Oracle of Omaha, with his humble beginnings and legendary status, has given us a glimpse into his investment world. Accumulating wealth, as Buffett suggests, isn't about being the smartest or the luckiest. It's about being consistent and patient. It's about sticking to a plan, like his 90-10 rule. A portfolio composed of 90% in S&P 500 and 10% in short-term government bonds, illustrating the essence of his strategy, simplicity and patience. We've learned that investing isn't about predicting the market's every move. It's about buying into companies you believe in, companies you understand, and holding on to those investments for the long haul. It's about being fearless when others are fearful and being cautious when others are greedy. Remember, success in investing doesn't come overnight. It requires time, patience, and the ability to remain calm in the face of market fluctuations. As Warren Buffett once said, our favorite holding period is forever. If you've enjoyed this journey through Warren Buffett's investing wisdom, don't forget to like this video and subscribe to our channel for more insightful content. Remember, as Buffett says, the most important investment you can make is in yourself, so keep learning and keep investing wisely.